bit after 5 p.m. Central Time, the best time. You know what that means? It's time for Tasty Live's evening show, a little podcast called The Price of Truth, a place where we like to explore the incentives that govern our world. It's going to be a solo show today, baby. Just me and you, which means all of you people. What do you mean you people? All of you people watching tastylive.com, all of you people watching Tasty Trade desktop and on the Tasty Trade desktop and mobile applications, you got to head on over to the evil Google YouTube, type in Tasty Live, find the live sessions. This big head will be on a big red thumbnail somewhere. Jump in here, introduce yourself, tell us where you're joining from. Tell us whether you made money, you scratched, you lost money, whether you're angry at the world or you're happy. It's almost a weekend. It doesn't matter what you say. Just type in random-ass characters so we can spoof the Google algorithm into putting us in front of as many people as possible and save the world one view at a time. Speaking of the people, because this is a podcast by, of, and for the people, as so few things seem to be these days, we should say what's up to the people. Shout out to everybody in the YouTube chat as you guys are getting in here. Do me a favor, hit the like button and start squawking so I can shout you out. Our good producers have got you guys up on the screen. That's the way we do things here, right? I don't just get to hog the microphone. You get a say in the topics. At least you get, at least your voice is heard, right? That's the whole idea. Not less speech, more speech. But I guess, I don't know. Seems like I'm in the minority of that with each passing day. We're moving the Overton window on free speech, everybody. You don't see it, but you will. And hopefully it's just not too late by the time you do. That was a weird aside. What's up, everybody in the chat? Shout out to Cactus Leo, Brian Thornton, I see you. What's up? Catan, great to see you again. Cato Prime, Brian Watson, Agent X. What's going on? We are in the Matrix, and Agent X has joined us. Lone Sophos, what's up? V-Dub, I see you. Douglas PC, Adam Green, good to see you again. What do you mean, you people? Exactly. Sterling, what's going on? From Greenville, North Carolina. Hopefully you're out of harm's way over there, Sterling, as well as all your friends and family. Thoughts and prayers go out to you and everybody in North Carolina, across the coast, and everybody impacted by Hurricane Milton, and the not just the hurricanes, you're dealing with tornadoes at the same time. Good God. I think they wrote something about this in Revelations, but I'm not going to go that far. Chaz, what's going on? You the man. No, you are, Chaz. You are. Baja, what's going on? Mind Power, Soul Train, Christian, and everybody else. I would love to just stay here shouting out people in the chat, but I'm told that I will not be paid if that's all I do for 90 minutes. So I can only do it for a few. But let's have some fun, everybody. So let's. I really appreciate the energy. Soul Train says, "Let's go." That's what I'm talking about. LFG, Soul Train. Let's go indeed. So shout out to everybody. A little bit of, I don't know, an upwards day. I don't know. Not much doing here. It was basically we were red across most of the screen, but not by much, right? We're down a couple of points. The Russell probably was the worst performer of all four of the major indices. Vol still hanging around at 21. Or near 21, 20.93 for you, all of you, highly analytical minds that don't like when people round up. But we're right around 21 in the VIX, and VIX futures at 1965. If I told you that we're going to get this CPI report, it's going to come in a little bit warm, would you have guessed we would have gotten the market reaction we got today? Would you have guessed that vol would basically stay pinned up here at 21? Would you have guessed that bonds wouldn't have really moved? And would you have guessed that risk was just slightly risk off? And that commodities, that arguably treasuries had made the move, I don't know, over the last couple of weeks, and the only area that seemingly hadn't made the adjustment was commodities. And we'll talk about all of that and the downstream impacts into materials and so on and so forth. We'll talk about all that here in just a moment. But, I don't know. I think it was an interesting day in some ways and a very, very sort of unenthused reaction in many other ways. I think I saw Rick Reeder, who, over at BlackRock said something that I resonated with, which was effectively, we're so conditioned to caring about these CPI reports. And, all of a sudden, the question is, how much should you care? Because the Fed has sort of already told you that they're more worried about the labor market than they are about inflation. They're sort of already telling you that you should expect inflation maybe coming in on the upside a little bit here. I'm surprised it came in as fast as it did. I thought we'd have a couple more months of cooling inflation, but that seemed to not be the case here in the immediate short term. We'll keep working around the horn, though, but VIX still stayed elevated. We should probably throw up the actual number here real quick. Sorry to blast your eyes with a bunch of white light here, especially those of you in a deep, dark basement somewhere. But CPI did come in. The consensus was 0.1%, the actual at 0.2% on the headline number month over month. Year over year on headline, the expectation was 2.3%. The actual was 2.4%. In context, warmer than expected, but still lower on a year over year basis than the previous reading. Core month over month came in at 0.2%. So core is stripping out energy and food. The actual was 0.3%. So we were warmer on core month over month as well. And we were warmer on core year over year as well. 3.2% was the expectation. 3.3 was the actual. This one is actually reaccelerating above the previous report. So headline, which is what everybody's going to talk about, right? I saw a bunch of reports today. The CPI is down for the sixth straight month. There was like something like this. And I go, what? No, it's not. No, it's not. But, people can make the statistics say whatever they want. The point is, more or less, it was a very uninteresting reaction from the marketplace today, in particular in the Treasury market. The 2-year, as you take a look, as you would expect, a pretty wide range today in terms of the high and low, but from the open to the actual close, we didn't really do much. And in fact, if I told you we're going to have warmer than expected inflation, would you say bonds rally or bonds sell off? The first order thinking is that bonds likely sell off a little bit on that type of news. Why? Well, because inflation means, less purchasing power of the bond. Therefore, the price goes down, the yield goes up in order to offset for the lack of purchasing power. See, the problem is, and a lot of this is the question that you and we understand this, but somebody that's reading the headlines, somebody that's new to trading, they think the headlines are going to dictate the price action. But the question we have to ask ourselves is what's in the price, right? What's already in the price? In the marketplace, had been moved, the 2-year had moved aggressively. I think at one point we were like the yield on the 2-year was like, we can use these instruments. So these micro yield futures are nice because they give us a proxy for what the actual yield was. So in just the last couple of weeks, the 2-year yield, not long ago, we were at what was the low here? 345. And so that 2-year has already spiked up from 345 a few weeks ago up to 365. So it's kind of already made the move of demanding more yield in the short term. And you could say that about both the short end and the long end, right? The 10-year, which we've been talking about, has had a pretty dramatic move from 115 in the 10-year note down to 112. In yield terms, again, we can just use /10Y. And we can look at what that means in yield terms. Again, price moves opposite bonds. So at one point in time, we were in the 10-year, not too long ago, we were trading as low as 3.595. Let's round that off and say 3.6. And we had, for many reasons, we had talked about why that seemed to not make a lot of sense. I'm happy to go over that again, but I don't want to, bore you with the same narratives each and every day. But if somebody's new and wants that sort of refresher, I can do it. But for several reasons, if the Fed was going to move Fed funds rate down to 3%, why would the 10-year be at 3.5% if this is a healthy economy, or if we're in a no landing scenario, or if we were in a soft landing scenario, we're going to see accelerating growth or accelerating inflation on these cuts. All of those for all those reasons, a 4.5% 10-year made way more sense than a 3.5 10-year. And in just a few weeks, we have moved up and we're now right around 4.06 in yield. So over 4%. So exactly what we sort of had said, that a 4.25, 4.5 would seem to make a hell of a lot more sense than 3.5. Well, we've seen that play itself out. So the idea that, we were 0.1% warmer in inflation. Well, guess what? The bond market has kind of already been pricing that potential here on a reversal of monetary policy. And not just for the 10-year, we've seen the same thing in the 30-year. I don't think I have a 30-year yield, but it's the same idea, right? We've moved from nearly 128 in the bonds down to 120. And I got to be honest, I didn't think we'd see 120 this quickly. I thought at 125, we talked about this, we'd see some congestion in trading. We did, but only for 4 sessions. And it's been a one-way train ever since that rejection, that sort of check back on 125. It's been a one-way train to the downside. And I've been having conversations. Shout out to everybody that pings me on Twitter, whether it's, in public or in the DMs. I'll answer to both. My DMs are open. So I don't have to be following you or anything to send a message. So feel free. The point is, a couple of people have been talking to me. What do you think about the 30-year here? Or what do you think about the 10-year? What do you think about the long end? I think structurally, I still want to be short. I just think sometimes, again, things come so far so fast. I would rather be getting short. I would like the opportunity to get short at more attractive prices. And so I'm flat in the 30-year. I have some small upside deltas in the 10-year. Just because I'm a degenerate and I've got to have something on. I feel like to have nothing on across the curve, I can't live with myself. I don't know if I can sleep if I've got nothing on. So I have some stupid upside call spread that it's just a dumb thing just for me to pay attention. But the point is, I would like for the long end of this long end of the curve, so the 10-year note and the 30-year bonds, I'd love for the opportunity for those to rally for a couple of sessions, get us 2-3 points higher, with the opportunity to then start selling some calls or call spreads, or maybe even buying some downside put spreads. I don't love shorting the whole, is my point. Structurally, I still like leaning short the long end. So long end bonds, meaning that the long end goes higher. I like that idea. Especially where we are with the 10-year, the 10 versus the 2. So this is the chart. Actually, let's do it this way. First, we'll look at the yield curve. This is something we are going to continue to keep our eyes on here. That the short end of the curve, in terms of Fed funds futures, we're still up at 5%. But the tradable part of this curve, the 2-year, we see that the 2-year has moved up in yield to near 4%. The 10-year is paying just over that, 4.07%. So if we take what should happen is your 10-year yield should be yielding more than your shorter maturities. So then your 2-year yield should be less. For a long time, that was inverted. You could actually get more by lending out money for a shorter term period of time in the 2 years than you could for 10. Well, why would you do that? You wouldn't. So most of the money was moving towards shorter maturities. And so what you had since July is you've had this normalization of the yield curve. The yield curve went from deeply inverted, where the 10-year was yielding much less than the 2-year, to the 10-year now yielding just a little bit more than the 2-year. So about 11 basis points or so. And I think this is as of the close here today. But we got in tight. I mean, at the end of last week, we were only 5-6 basis points, something like that, over. We basically moved back to flat. My point is that I think I like the steepening of the yield curve. What is the steepening of the yield curve? That is effectively buying the short end and selling the long end. And you're just hoping that the relationship, no matter if they go higher, which would be, yeah, no matter if they go higher or they go lower, you just want the 10-year yield, the difference between the 10-year and the 2-year to widen. You want that spread to widen over time. And that would be a more normal, sort of a normal rate environment. And I think the more that the market gives you an opportunity, the more we go back towards flat, or even, God forbid, we invert again, I think there's going to be an interesting opportunity to keep putting those steepeners back on. So I think it's 2-to-1 is the ratio. So you buy 2 of the 2 years, you sell 1 of the 10-year futures, and then that is effectively playing the widening or the steepening of that yield curve. And I probably missed a really good opportunity to put that on yesterday, when we were in single digits. Now that we're at a little bit wider, 10, 11 basis points, I still think you're getting it's still a decent trade, but we had widened out. The max we've seen so far is 26 basis points. So at 6 basis points, you're looking at a potential, given the structure of the market, you're looking at a potential of that widening out for 20 basis points. That risk reward to me seems really interesting. At 10 basis points, you're looking at it widening out 16 basis points. So it's not as interesting, but it's still, I think the potential there is for more reward than risk. If you think we don't invert, you think the probability is low of an additional inversion of the yield curve. If you think the probabilities are low of that happening, well, then you probably have 10 basis points of downside, 16 basis points of upside, given the existing structure. That's assuming we don't widen out even more than we did in the past. That was a long way of saying one of the things that I would like to get on, if I can tomorrow, is probably that steepener again. I don't know if I got to be disciplined or what, but if I can get that thing on in single digits tomorrow, if it tightens up a little bit, I'd love to get that on before the end of the week. What do you guys think about the steepener here? Right around 10 basis points ish. Is it something you guys are interested in? Or are you just playing bonds directionally, like just trying to pick the direction of the 10-year or the 30-year? Or is it some combination? Tell me what you guys are thinking about both the short end of the curve, the long end of the curve, and trading them as a pair as well. I'm really sort of kicking myself for not getting in there and putting something on earlier this week or at the end of last week. That was sort of a gimme, and I didn't do it. Let me see what you guys. Let me pause for a second. Let me see what you guys are saying, then I'll keep going. Short UAL is killing me. Yeah, man. All of these. I'm gonna go to Jets first. So Jets is the ETF that tracks all the airlines, all the major airlines. But I'm pretty sure they're all in there. What are there? 8, 9 of them publicly traded, something like this, maybe 11. But the airliners have just been vertical line to the upside, straight up vertical line. So I'm imagining most of the airliners are going to have that very same chart. Yeah. United, brutal. Delta had earnings not long ago, so they got a little double top happening here at 52. Here's probably the only airline you're not going to see the nicest chart on, which is Spirit Airlines. But yeah, let's see here. What's the record for how many days VIX or VX over 20? That's a good question. I don't know the answer to that. Excuse me. Sorry about that. Not feeling great. I don't know the answer to that. It's a good question. I'll run a little script here, and I'll have that answer for you on Monday. No Tesla's caught on fire in the last few days. Shocking. Not much happening here. Why did the market not move today? The buyers and sellers were at equilibrium. That's kind of the a-hole answer. I don't know what the major catalyst would be. because bonds didn't move. The only thing that really moved were commodities. So when I look at, we'll just look at the little sector performance, right? What outperformed? Energy, because we had a nice move in crude oil, and materials, because gold, silver, copper, a lot of those commodities were a little bit stronger here today. Everything else was slightly negative. Uh, so not much of an up. There certainly wasn't an upside catalyst, and with at a 20 VIX and a number that didn't seem to spook the market, because again, bonds didn't adjust, so it seems like they had priced the outcome. Vol didn't collapse or expand. And the only thing that happened is commodities ran, dollar strengthened a bit, which is sort of strange and interesting at the same time. I would ask you, why should it have moved? Perhaps as the opposing question. Where's liquidity coming from? Oh man. Where's liquidity coming from? Easing monetary conditions, fiscal impulse of the U.S. government, Chinese PBOC, Chinese fiscal stimulus, easing global monetary policies. Take a number, man. Liquidity's coming from everywhere. Add to that immunity to CPI, the fact that we cannot trust numbers from this government at this point, and you start to make all the macro numbers completely irrelevant. See, the thing about some of these numbers is I just think, I don't know if I distrust CPI. Let me qualify this statement. If you know what it's supposed to be telling you, there's a difference between what it's supposed to be telling you, how it's calculated, and what people think it's telling them, in mainstream media or sort of like the general public. I think if you know what the number's supposed to be telling you and you know how it's constructed, there's no reason to not trust it, I don't think. Well, I guess what's the, I don't know, maybe I sound a bit naive, but I just think these numbers are constructed to do something in particular. And CPI is constructed to have, structural pressure on that number. Unemployment's constructed to have structural downside pressure on the number. And so it just is what it is. The non-farm payrolls, though, I have no idea what's going on with those, Sterling. It's well known that there's something called the birth-death model. Effectively, it's not exact, but basically it adds 50,000 jobs to the report. And what it's doing is it's trying to net out how many businesses are dying versus how many new businesses are being created, and the jobs that those new businesses are creating versus the companies that are dying. And there's that's always been a little bit like, I don't want to say controversial, but at inflection points, economic inflection points, that birth-death model tends to really skew the data. And so whether or not it's really just that birth-death model or whether there's a bunch of other things going on, survey respondents, people will talk about how less people are responding to those surveys. So what I would say is these numbers are way less scientific than you think, right? We think they're like very, very scientific, but in reality, they're surveys. Some of these things are surveys. It's not like some scientific, this is exactly how many jobs the economy has added. It's a survey, and there's all types of biases that can be put into a survey, right? If you're homeless and I need to get a hold of you to figure out whether or not you got a job or not, am I going to get a hold of you? How would I get a hold of you? Probably not, right? So that's something called sampling bias. So there's all these types of things that if you got to know what the number is actually doing and what it's not doing. I think tends to be like a gap in understanding of what these things are. But I don't know if somebody's like erasing it and writing in a new number or something like that. I don't know that that's exactly what we're doing. But I think that it's right to be, I think, critical of whether the number reflects reality. Does CPI reflect inflation, your personal rate of inflation? Probably not. The jobs that are added in an economy right now, did we add 250,000 jobs last month? I don't know, probably not. But it is the number that we're all going to operate on. So take that for what it's worth. Victor, I gave in to the beast and put on a yin trade. What's yin? What is that one? What is this one? Didn't we talk about this the other day? I forgot what it was though. Ultra bull, the 3-time China bull trade. Oh man, I needed that one. Catan, you are a mad person. I think the interesting thing is they have scheduled a press conference on Saturday to talk through, I think, the fiscal plan, potential fiscal stimulus. So it stemmed, I think, the bleeding in a lot of these Chinese stocks. So a lot of these things have like taken a pause and a breather off of that announcement. And so there's a very real likelihood, right? You go into Saturday, the whole market wants to see what they say. You get additional stimulus or a dovish announcement out of that. Who knows what that could do as an upside catalyst to these Chinese stocks. But if you don't get an additional catalyst, that's 2 meetings in a row that has disappointed the markets. And that initial correction, it seems to be over. As long as there's the expectation or at least the carrot in the future of additional stimulus. And right now, you've got a new carrot, right? This is almost exactly, take yourself back to the beginning of this year. There continued to be the carrot of cuts on the horizon. We come into this year, 6 or 7 cuts expected. We get close, we're going to start the cutting cycle in March, or then it was, midsummer, late summer. But there was always this carrot of easing monetary policy, and then not also a bazooka of fiscal stimulus. So it seems, at least for now, there's continues to be, with at least Chinese stocks, this carrot approach. We'll see how long that lasts. But Saturday is going to be a big day, and then so coming into next week, I would expect volatility based on that, based on the outcome of that discussion on Saturday. Up or down, you call it. I have no idea. So, Catan, for your sake, I'm hoping you get a nice little spike on Monday. Let's see here. I'll do a couple more, and then we'll get back on to our previously scheduled program. See, this is what, you know what I mean? I love pre-recorded just as much as the next person, but if you can't talk to the people, I sort of think this about the current state of politics. If you can't sit down with somebody in a live format and take open questions that could be anything, with any level of difficulty, with any level of criticism or flattery, and respond to that in real time, I don't know that I entirely respect those types of content creators. I know that they're good, but I would like to see those content creators, those pre-recorded, I want to see them in a live environment too. And if I see them in a live environment and they're able to hold their own with a savvy audience, then I've got a lot of respect for them. Same thing with politicians. I think seeing how a person moves in a live environment, that's incredibly important. Seeing how quickly they operate, what their real thoughts are when you catch them in an unscripted environment. I think that's important. And it doesn't seem like we're seeing that all the way from the candidates right now, which is a bit frustrating. Anyways, let's see what the people are saying real quick. Best explanation of bonds. You like that? 10 years talking to me? Is it? See, that's the thing, man. When we do this for so long, right? You do this for 6.5 hours if you're just trading the regular equity markets. You're trading longer than that if you're trading currencies, crypto, and futures options. So we get nuts a little bit, Help Me 100 says 10 years talking to me. That's what we start to think like. Noah says bank earnings kick off. Wondering if Diamond's foreboding statements last month could appear to be materializing in the reports. I don't know, man. For somebody who said the hurricanes are coming, and he meant it figuratively about the economy, his stock sure has done pretty well since his economic meteorologist forecast. In the 135 handle to 225 in less than a year. It's not bad work if you can find it, but I'll throw up the earnings calendar here. To your point, Friday, we're going to get JP Morgan. We're going to get Wells Fargo, Progressive, if you want to throw that in there for insurance purposes. Did anyone see what insurance, the increase in rates of insurance in the CPI report? Insane. That's like the most mafia move of all time. I want you to think about this, okay? I want you to really think about this. A few years ago, you either bought a car, maybe you refied a car. I don't know if you guys lease or you loan or you pay cash. I'm kind of like, when it comes to buying cars, I'm like Randy Moss. I'm straight cash, homie. But people were able to finance their cars at these super low rates. They finance their home at these super low rates. They get into their homes. They get into their cars. And they're like, wow, I got a great low rate, or I refinance. I got extra discretionary income. Our insurance companies were like, no, we need that. I need that, bro. Come off of that. You see that extra discretionary income you got with a low APR, low mortgage, home insurance like, nah, I need that. You got a low, you have a low car payment, which, by the way, people don't. Some people's car payments are astronomical, like what a mortgage used to be. But car insurance companies, I need that. So it's like the benefit of locked in low rates completely disappears when your insurance is going up 30 or 40%. It's the craziest racket. It's the most gangster mafia move of all time. And they all move together. It's not like you can get some cheap car insurer over here or some cheap home insurer over here. They all went up. Gangster. Anyways, Bank of New York Mellon reports as well. I have no real thoughts on the banks. I would expect them to have a decent quarter, or a pretty solid previous quarter reports. Why do you say that, Victor? Well, because look at what their stock has done. And again, it's what's in the price. So don't be surprised if you see them report blowout numbers and perhaps you don't get this massive reaction to the upside. Why might you not expect that? Because the option market is not really expecting much. A $5 move on a $200 stock, that's a 2.5% implied move, a little bit less. So it's, the option or the implied move is not expecting much in terms of fireworks. And it's not about necessarily the previous quarter. It's about the future, right? It's about the forward quarter. And I wonder if we're still in an environment where people continue to price in cautiousness about the future, right? That's what they've been able to do. They've been able to sort of undersell and over-deliver. Everybody, especially the banks, especially Jamie Dimon, who was the most bearish about the economy and the potential risk on the horizon. So, yeah, I mean, I would expect their previous quarter, given trading activity, given fixed income, given volatility, I'd expect them to have a decent quarter. But that's not, I think that's already in the price. And it's what do they say about the future? And just know that the options market is not pricing much of an interesting reaction tomorrow. 2.5% on JP Morgan. And I'm guessing Wells Fargo is a little bit higher because they're sometimes a dumpster fire compared to JP Morgan. $1.71, a little bit more, not much. A little bit more. What's that? Like 3.2%, 3.4%, something like that. So a little bit more, but not much. Let's see what you guys are saying. We got some long 10 years. I'll be in LA next week. Airlines have been beaten down the past 2 years. They were. I agree. All right, let's see what you guys say. Pet insurance. Pets. You can't talk to me about pet insurance. Don't talk to me about pet. Like, this is where I'm going to lose probably half the audience, but I don't care. I say it anyway. Don't come at me. I'm not. My sister, she's 2 years younger than me. We had a zoo when I grew up. 2, 3 dogs, 2, 3 cats, a rabbit. She'd find birds. I mean, it was just, and when I was a kid, I had like a sneaker collection. So they would tear up my shoes, piss in the shoes. So I don't want to say I do not like animals. Well, let's just say I've developed an indifference to them. And so when people tell me what they pay for their pets, what they, I see people walking around with like a little stroller for their dog or something like this. I can't empathize with you. I know you love your pets. That's great. I don't hate animals. It's not like if you leave me alone with it, I'm going to swat at it or something. It's not what I'm saying. I'm just saying I don't get why people spend so much money on pets. Premium dog food and all this stuff. No way. No way. And by the way, my son, he's getting to that age now. He's almost 5 years old and he wants a pet. He's asking for it constantly. And I don't care. But his mom is, this is what his mom said to me when nobody was around. She goes, I don't want anything else that I have to keep alive. So that was her way of telling me we're done having children and she doesn't want pets. I see. I knew I was going to lose half of you guys. Pet didn't like you. I don't know. It's the evil Victor Jones. I knew it. It's not like I don't like them. I don't get when people are like, here's my favorite thing. If I ask somebody in my age range, I ask them, oh, do you, they tell me they're married or something. I'm like, oh, okay, you guys have kids? And they go, no, we've got a dog. I'm like, what? Only a person without kids thinks that that's anywhere in the same ballpark. Only a person without kids thinks that like those two things are in the same category. I can't tell you how many times. I'm in Chicago though, so maybe we're just, the liberal side of Chicago is a little wild. But asking someone, do you have kids? No, we've got a dog. All right. Excuse me. VJ, get a robot dog. No, man. I'd rather get a real dog than a robot dog any day. Those people are insane, bro. Exactly. Again, nothing against dogs. If I'm losing people, I really want you to understand I'm not an anti-dog person. I'm just how in God's name do you think that's equivalent to raising a human being? One day they'll figure out how silly those types of comments are to other people. Somewhere in here, I'm probably silently roasting one of you who said that before, and I apologize, but I stand by my statement. Let's keep cruising. I want to get some hate mail on that one. If you do want to send me an email, you're more than welcome. Victor.jones@tastylive.com. I'm way quicker on Twitter, though. But if you do want to send me an email, you're more than welcome. Victor.jones@tastylive.com. That includes market-related stuff or just straight hate mail. Send anything my way. All right, crude oil, 75.64. A nice little rally here today from sub 74 up to 76. We faded a little bit and extended by 20 cents. But we had a very, very big... VP. No, VP. VP says, I hate you, Vic Jones. Come on. You know what? I think I can navigate political discussions in the sweet spot of not really pissing Republicans or pissing Democrats off. I think I can do that better than I can navigate the not pissing dog owners off. Somehow I have an inability to walk that line in a highly polarized political world. I can navigate political discussion more than I can animals. All right. Anyways, the point is, what happens when you get a nice crude pop? Energy follows. I've told you guys all that I started to put some chips down in the energy world, and it's not because, it's not a 1 day, 1 week, 1 month trade. I do not know if these things are at lows. I don't know if the economy is out of the potential for a recession, and if that is the case, depending on how the recession comes, right? If we get a slowing growth with high inflation world, sort of a stagflationary world, which is possible. Everyone wants to poo-poo that as a possibility, but I could totally see a world where we're printing like we've lost our minds, which is increasing the price of limited assets. What's a limited real asset? Any commodity, right? These are scarce, precious assets. So those things go up, stock market's going up, but we have slowing growth. I don't know that that's exactly what we're looking at, but I'm just saying that that's not impossible. Anyways, in that world, then, who knows? Energy could actually do well, even though you would expect in a recession for energy demand to decrease, which it might. But the question is, what is the offsetting printing and liquidity doing to scarce assets? And in the case where we don't have a recession, that growth stays relatively elevated, or at least at trend. I have said this to you guys as many times as I can. My whole thesis is there's only 3.5% of investment dollars in the S&P are towards energy names. There's only 3% in utility names, so it's 6.5% total. 30% is in a concentrated basket of technology, and I can whittle that down to like 20 something percent is in 7 names. And I think over the long stretch of time, I'm 38 years old, so I got a couple of decades left before I'm thinking and talking about retirement. I would like to bet that over that long stretch of time, that energy and utilities may not be such small single digits over that time. And that's my longer term, very simple thesis. For that reason, I started to pick up some energy names. They did well today. So Marathon Oil's back at the top end of its trading range we've been talking about. Occidental Petroleum, all this stuff had a decent day. No crazy outlier moves for some of this. But again, most of these energy names that we've talked about on this show are higher beta. So they're going to move at a higher clip. So we got some decent moves here today. All these things, hopefully we can get a nice little breakout in Devon. Look at that chart. I guess if you see the breakout, that's a good chart. If you see the rejection of the trend line, you guys know what I'm talking about, then that's not exactly the most exciting chart. But I'm an optimist. I'm an optimist. Who sees the breakout? That's what I want to see. Let's see here. Brian Thornton. Wilt says, starts typing angry email. VP says Vic Jones is a cat person. Oh no, I'm equally aggressively neutral on both. But if I had to pick, I'd pick a dog for sure. Now I just lost probably all the cat ladies, if there are any. Brian Thornton says, the worst is saying they rescued the dog. I have 2 dogs and they're amazing, but I didn't rescue them. I rescue a couple of foster kids, so I figured it evens out. Brian, isn't there, who has a great bit? Bill Burr, I think, has a great bit on rescued dogs. He says something like, oh, did you rescue him? Did you run into a burning building and and run out and save the dog with flames licking at your back or something like that? Or did you just go to your local shelter and get a free dog? That's his bit. He tells it better than I do, of course. Steven says, the bond market is killing me right now, down 7 days in a row. Steven, I mean, I wouldn't say that's why you gotta tune into this show a little bit more. Tune into this show. We were telling you post-cut, there's no reason to be long. Maybe flat, but not long. Maybe now. Now you might be getting an okay price on a counter trend move. I still think the trend move is down. I think everybody's smoking. I think everybody's completely smoking, and they think because they're seeing yields that they've never seen before and they're seeing prices that they've never seen before, they haven't seen in their trading career in the last like 10 years, something like that. Everybody's licking their chops, and I think it's a mistake. I think it's a mistake. I think as soon as we get through Milton, the first thing that the current administration is going to do is they're going to pressure Congress to come back into session because they're on recess until after the election. They're going to pressure them to come back in session. Why? Because the $20 billion that they funded FEMA with is not going to be enough for the total damage on Florida, Helene, which I think the insured losses, the last time I checked, was $11 billion. That's not total losses. That's insured losses, $11 billion. And the total estimated damage for Milton was up to $175 billion in damages. Now, the thing is, the estimates that they put out before these hurricanes hits are always dumb high. Like they're all, I think the total damage on Helene, it was like $150 billion with the initial estimate. So they're always these eye-watering numbers. But what was Hurricane Ian? I think Hurricane Ian's insured losses was $56 billion. So if these things start adding up, to me, that's an obvious forcing function for us to get together another spending bill. And I'm not saying that's a bad thing. If you're out there and across the Atlantic or the Gulf, you want something done, and I get it. I sort of don't understand what the insurers are for. But anyways, I just think we're going to continue to see these types of forcing functions that force us to run, even if we don't want to. What are you going to not support the people who have had their homes destroyed? You have to. And I think we have run our budget in a way that assumes that we're not going to have things like the pandemic, right? And I know you don't plan for a 1 in 100-year event, but we're running this stuff as if we're never going to have emergencies. And then the emergencies create really big fiscal problems for us. And I think that's, at the end of the day, we keep running these deficits. And our interest spending keeps growing. And then we either have to decide to print more money to cover the interest expenses plus the additional spending, or we cut spending. And who's going to cut spending? Do you see anybody running on that promise right now? Because I don't. And if that's the current case that we're in, then why exactly am I buying bonds again? Why should I trust that the purchasing power, the existing yield, is a decent investment? Again, I know that the monetary system treats these pieces of paper as collateral, and for that reason, there will always be sort of this structural bid for these bonds. But that's not what I'm saying. What I'm saying is the yield on these bonds. Why should that not continue to go up as we continue to have a less fiscally sound situation? Why wouldn't it? Why should it go down? If we have a credit event that trips a run to collateral, then yeah, sure. Yeah, I get that scenario. But I don't think that's why people are buying bonds right now. They're buying them because they think they're getting a deal. And I think over a long enough time frame, to me, that's silly. I don't think anyone's getting a deal unless the Fed steps in and says, okay, we're going to buy these pieces of paper and sort of limit the pain of higher yields, but that's monetary debasement. And I just think that is our destination. It's just, how do we get there? What kind of random path do we take to get there, and how long? That's my point of view. Stephen Crane says 3 dogs, hates cats. Catan says my cat sits around the house for house parties. He's mad crazy. My friend from Florida got an email raising your car insurance rates already. Yeah, they're sort of like, especially I think Geico sent out a note about Teslas. Either, I forget what it was. It was something on flood damage or potential fire damage. And so basically all that stuff is going to go up, which is brutal, right? Can you imagine being in the middle of trying to take care of all this damage around you in your home, and your car insurance company says, hey, we got to jack your premiums. All right, I'm going to get back on topic here in a second. I need fewer cars. Grumpy Mike with a rich man problem. Let's see what's going on here. One I put 500 miles on in 2018, probably 200 miles since. Another that might have 100 miles on it since 2015. And another has not had the body installed since 1977. First of all, yes, you have too many cars. You know, you're part of the problem, Grumpy Mike. You're one of the reasons that all the elites are telling us we can't have stoves and we got to drive EVs because of people like you. What's the 1977 car? What is it? I know it doesn't have a body installed, but what would it be should it have a body? Brian Thornton, last one, and then I'm going to get on to I'm going to get on to materials here. Isn't a good read through on inflation a natural disaster? Basket of diversified goods, easy enough to run a regression on. Isn't a good read through on inflation a natural disaster? I sort of see the thinking there, Brian, but I don't know exactly what you mean. Unpack that for me a little bit. Excuse me. All right, let's keep going. So we talked about crude oil, a little bit of lift there. Energy followed. Excuse me, nat gas, a little bit bid here today after a couple of brutal sessions. Is this excuse me, do we want to be selling puts here? Ugh, that Ivy rank is gross. But the individual implied volatility, not bad. Is anyone selling puts on natural gas here? You know, we look like we put in a bottom around 2.5. We got a nice 4-day sell-off. A little bit of a bid here. Is it too early? Oh, the continuous contract looks way different. Look at the continuous contract versus what's this in November? Yeah, X4 November. Continuous contract gives you a way different picture of what's going on in natty gas. I don't have anything on natty gas. I don't know. I kind of want to sell some puts there, but it doesn't seem like you're getting a very cheap price, I guess, when you look at the actual continuous contract. You're up against resistance, really. All right, I'm going to have to skip that one for now. Gold, I have nothing on. A little bit of a rally here today. A little bit of a rally here today, but no reason for me I don't want to be short this thing and I don't want to be long. I would like to buy gold at lower prices. At this level, I don't like it. But I still am holding on to all of these miners. I just can't put them down. And for whatever reason, it's rewarding us so far. Newmont Mining, Barrick Gold is another one. GDX. GDXJ, a lot of these miners and junior miners did well today. And we brought up silver miners the other day. Did you guys see what Pan American Silver did today? Some of you did. Some of you bought it the other day, or at least got some long deltas. Huge day in Pan American Silver. I'm going to do one of these here. Nice little rally in some of the silver names. So again, the materials did well today, which is surprising. I told you normally we get a 3 to 5 day pump, and then all these things, they sell into them. Whatever that enthusiasm was, they just kill them. But a little bit of stabilization, at least for now. Copper had an okay day. I mean, it maybe we stopped the bleeding here in copper a bit. So same thing as Chinese stocks. They stopped falling. They rallied a bit, and I think you saw the same thing here in copper. They stopped falling, rallied just a little bit here today, and we're in the materials. Freeport, McMoran. Is there any others? Handful of others that aren't copper specific, but energy and utility specific. I've talked about these a few times. NEE, SMR, which is a high beta name. If you want something that whips around, it's probably not even a real company. Probably not even a real company, but this thing whips around like it's crazy. I do not collar this one, so this thing could be, it's like up and down $5 within a couple of weeks. So if you need some excitement in your life, get you a high beta utility play. What were the other ones? PEG, I think, is one I own too. It's another utility. Yeah, I think those are them for the most part. PGNY, I had a nice back and forth. I'm not going to put their name out there. If they're here watching, they can say it themselves. But a nice back and forth with somebody on Twitter about PGNY, which is Progeny. And I ended up buying some more yesterday. Again, this thing has just gotten brutalized. What is the name? What is the company? It's a company that has to do with female fertility, so IVF treatments, those types of things. Again, long arch of time. Who knows? Maybe if Trump wins and he makes RFK his Secretary of Health and Human Services, and who knows, over the next year we clean up our air, food, and water. Maybe the trends in fertility change a bit. But barring that miracle of circumstance, the likelihood that we continue to see fertility challenges, I kind of think is high. And this name got murdered because it lost one of its one major customer. That customer was responsible, I believe, for 12 to 13% of its revenue. I don't know that it's been confirmed, but the speculation was that the customer was Amazon that they lost. Shout out to this person who actually had the back and forth with me on Twitter in my DMs for pointing me to that. I didn't know that customer was, or that the speculation that the customer was Amazon. So putting it out there, it's this one and another theme in this same area is Hims. So again, dropping testosterone levels. I think these guys do hair loss pills and ED pills. And if I'm not mistaken, they just launched GLP-1s. So to me, I think that's kind of an interesting mix, right? As millennials start to get older, Gen Z gets a little bit older. I don't know. Maybe I'm crazy. I never like to do narrative stuff, right? What I'm giving you right now is a narrative thesis. I'm not speaking to the fundamentals of the company. I'm not speaking to the technicals of the company. But sort of the narrative thesis is where I start, and then I go look at the companies internally. All right, let's see what you guys are saying real quick. I'll pause. Is it pointless to trade if you don't code a bot? I haven't coded a bot. I don't personally feel like it's pointless, and I'm sure there are many others here. What I would say, though, the flip side of that is I would say I've been doing this long enough that I'm fairly mechanical about what I'm doing. I probably have a little bit more discretion in my style than maybe I want to, and probably most. But I kind of like that discretion. To me, there's an aspect of this which is sort of a business. It's a job, and that's the mechanical part. And then there's an aspect to me that every once in a while likes to have a little fun. And that's where I spend a little bit of my capital in a more discretionary manner. But I would say for the most part, it's fairly mechanical. So I don't think you need a bot to be mechanical. So I think a lot of what Tasty talks about are the mechanics to execute on a day in and day out basis. Would a bot help you to be even more mechanical in your execution? Probably. So I wouldn't be against it. I would not say you need to do it though. Let's see here. All right, you guys are going back and forth on your own stuff, which is very cool. I will move over. I'll do the yen really quickly. I have some upside calls in the yen, and this is more or less, I think, going to be a part of a hedge. I don't know if it's necessarily a hedge. It's probably uncorrelated to what I've got on for the most part. So I have some upside in calls in yen, which are not doing well at the time. It's a small position, but I don't know. I think we've retraced about 30% of this move so far. Got to be getting tired, you know? Got to be getting tired somewhere around here. Vol is not that interesting, though. That's the problem. Let's see. Gold. Oh, silver. We got a nice little upside move in silver today. I am up long upside calls. Do you guys have an opinion on silver? I kind of think I really like the high beta play here in silver. I don't love gold at 2,700, but for some reason, perhaps because of the additional industrial uses for silver, I like its potential upside here. And the only way I don't want to own, just as a word to the wise out there, or anybody that's new, if you're getting into silver for the first time, this thing moves like it's insane. And the SI contracts are big. And even the smaller one, which is SIL. So if you're trading the futures /SI, this is a pretty big notional contract. And even the micro, which is 1,000 ounces, is still a pretty big contract. So I would just say a word of caution to anyone out there. If you've never traded this before and you want to get some exposure to the upside, the way that I do it is through limited risk, through options where I can manage the capital and the sizing of the trade. I don't like trading any of the ETF, the commodity ETFs, for several reasons. Depending on the term structure of the commodity itself, you've got built-in sort of roll, the cost of the roll, and the expense ratio. And so the drag that gets priced into these ETFs, I just don't like. And they're only open 6.5 hours a day when you could be trading a product that's open, a little bit more than 23 hours a day, or around 23 hours a day, I should say. Silver mooning over the next 5 to 7 years says absolute beginner. Go to the 5-year or go to the monthly chart. All right. It's your show as much as it is mine, I suppose. So in order to do longer term time frames, you got to make sure you change this stuff to the continuous contract. Otherwise, you're looking at nothing. So yeah, here's your sort of your 20-year monthly. I remember this. I remember where I was during this monster run. Isn't that funny? To me, charts, you ever listen to an old song that you used to listen to, and then you remember what car you were driving and like where you were, what city you were living in, who was driving around in the car with you? Like these songs kind of bring you back to these places in time. In a weird way, charts have that same impact. If you show me a certain product and I can tell you where I was on Netflix's rip, on the initial Crocs rip, on Canada Goose's rip, on Silver's rip here, GME, I can tell you where I was and what I was doing, how I was feeling, what I was listening to, how much I weighed. Isn't it funny? We do this long enough and we can associate charts and moves with different places in time in the same way that people will hear a song on the radio and think of where they were back in those times. Massive cup and handle if you go back to the early 80s. I'm not going back to the early 80s. I think that's a big mistake as well. One quick caution here before we wrap up, but like the word of caution is we've only had really 2 big bouts of inflation. I won't say only, but we've had 2 really big bouts of inflation, right? Through the 20s and through the 40s, I'll say 30s and 40s, and then the late 60s through the 80s, right? And so a lot of the times when I hear people, they give statistics. If they say something like within the last 20 years, this has happened so many times, I immediately just dismiss whatever they're saying. Why do I do that? Not because I think I'm smarter than everybody else, but because I think in order to have statistical relevancy in this period, in an inflationary period, to me, it's more relevant to go back and compare this time to what was happening in the late 60s through the early 80s, or what was happening in the 30s and 40s, because those were the periods of sort of these massive inflationary times. And I think when if you're using a data set that doesn't include some of those periods, I don't know that it's very helpful, because you're effectively comparing what is now an inflationary time to other periods that were structurally disinflationary, that were structurally disinflationary. When we were running QE, or when we had zero interest policy. Like, why should I be comparing those outcomes with what is in front of me right now? To me, that seems, why would I do that? We have a very different setup here. Isn't it more relevant to go compare things back to the 70s and 80s, or to the 30s and the 40s? So just a word of caution out there. To go back further, that's what I'm saying, is to expand your data references for research purposes. All right, everybody. I think, do I have a few more? I don't think so. I think I covered everything I wanted to. So what is happening tomorrow then? I'll do this really quickly. We've got PPI early in the morning. So two things will happen. When you get PPI, now that we have CPI, you get PPI. So you're on the other end of that. Plus, because you have those two, you can now price PCE. That comes a little bit later in the month. So the consensus is 0.2% growth month over month for headline, which is the same as last month. The consensus is that the year over year comes in a bit, down from 1.7 to 1.6. That core comes down from 0.3% to 0.2%. And again, core year over year is going to actually tick up 2.4% up to 2.7%. So those are the expectations for tomorrow's PPI. You have so many Fed squawkers still going on, but clearly not a lot of them are saying anything material, in my personal opinion. So that's what we have to look forward to tomorrow. Consumer sentiment tomorrow as well, which I actually do think all of a sudden is going to be relevant. Previous was 70.1, year ahead inflation expectations at 2.7. I think this one's going to be, it's going to be fascinating to see what the year ahead, the forward inflation expectations are in the survey. I mean, we all know what the implieds are in the market, but I do think how consumers are feeling about the future of inflation is sort of an interesting aside, if not market moving, an interesting aside. Then a couple of squawkers, Goolsbee, Lori Logan, and Michelle Bowman, who's spoken, I don't know, both of those, they've spoken like 2 or 3 times this week. Just an insane amount of Fed squawk. But I guess for some people, that's like Christmas, listening to those people. It was for me at one point, and now it's just like, get those people, somebody take their microphones away. Just let's all listen to the 2-year. All right, that's going to do it for us here. We're going to end a little bit early today, but do me a favor, hit the like button if you can. It's the easiest way to support me and support all of us here on the other side of the screen, the content that we create. Subscribe to the channel if you haven't. That's the easiest way to support all of the content, all of the content creators holistically. If you want, follow me on Twitter at Victor Jones, the O and Jones is 0, because I like to be difficult, or send me an email directly if you'd like at victor.jones@tastylive.com. Twitter is, you'll get a quicker response there. I want to thank all of you, Mr. Meaner, what's up? I want to thank all of you for sticking around this week and having some fun with me. I know I'm a purist, and I sort of hate to admit this, but I've been working with ChatGPT to improve the workflow on the preparation for the show. So we'll see how that goes. We'll be working on that this weekend. I don't know. Am I a traitor? Am I a traitor to my anti-AI thesis? I don't know. You tell me. Make me feel bad. Make me reject it again. I will see you back here on Monday Same time, same place, same great network, only on Tasty Live. Until then, happy trading, everybody. Best of luck. Peace.